In for Emily Chang, and this is Bloomberg Technology. Coming up in the next hour, some of the world's biggest tech companies, themselves often under antitrust scrutiny, bemoan Nvidia's acquisition of Arm, saying it will hurt competition. More on the case being made by Google, Microsoft, and Qualcomm. Plus, Social Capital founder and CEO Chamath Palihapitiya is known for being a disruptive force in Silicon Valley. Recently, he's been making headlines as a superhero for the Robinhood crowd on Reddit. We'll hear more from him ahead of next week's House hearing on retail investing and the state of the stock markets. And fresh off of earnings, I'm going to speak with the Datadog CEO, the cloud monitoring software company, beating estimates, but saying that 2021 revenue may slow. First, though, we are going to begin with that big story. Microsoft, Google, and Qualcomm have all protested Nvidia's Arm acquisition. It affected shares today. Bloomberg's Ed Ludlow has the report.
Yeah, that's right, Taylor. Sources telling Bloomberg that the concern here from those companies that you named is that if Nvidia successfully completes its $40 billion takeover of Arm, that gives it complete control over a key name in the licensing of chip design, the licensing of software that goes with the chips, to the exclusion of those rivals. Some of those names you can see on the board. According to one source, the FTC is probing the deal here in the United States. You can see the impact it had. Nvidia down 1.9% on Friday. Some of those names that are part of that complaint, according to sources, in the green, though, ending the week strongly on the back of that. Really here it is an antitrust issue at the heart of this, but the deal was going to have to pass several hurdles anyway, not just in the United States, but it's subject to regulatory approval in the UK, in the EU, in China. So certainly one to watch going forward.
This is part of the program where we interrupt the traditional programming, and it is Valentine's Day almost. So I'm going to sing a rhyme, and you're going to have to tell me if it accurately depicts what happened cross-asset this week in the markets. Let's go.
Go for it.
Roses are red. Bond yields hit 2. Dogecoin is higher. Equities too. How did I do?
Taylor, if only there was that level of poetry in financial markets every day. You've picked a day where there's simply no catalyst, no reason or rhyme, no up or down driving investor sentiment, other though than in the world of cryptocurrency. So why don't we just start there? Why not? It's been an amazing week in the world of cryptocurrency. Bitcoin hitting fresh records. Basically on the back of that Tesla news, I'm laughing. I cannot believe that you've just said that on air. Tesla investing 1.5
previous hour.
Tesla investing $1.5 billion in Bitcoin, having a big impact. You can see there the Bloomberg Galaxy crypto index hitting a fresh record high. Other cryptocurrencies in on the act as well. Ether, the world's second largest Bitcoin by market cap, also hitting a fresh record. Lots of inflows into that. And elsewhere, though, the market really working out what the driver is here. We've had no real substantive progress on a stimulus bill. We're watching vaccines very closely. And what we saw then in US equities is really most major US indices fluttering around record highs, not moving with any real conviction in either direction. The S&P 500 up 0.5%. Some slight outperformance in technology. The NASDAQ 100 up 0.5%. The NYSE FANG Plus index up 0.6% after we've had all of those mega cap tech earnings that are now out the way. If there is one outperformer, it's the Philadelphia Semiconductor Index. This is one of the stories of the year so far about the chip shortage, the impact that a shortage in silicon could have on certain names in the automotive industry. And actually, Taylor, if there's one guy who speaks about the markets and about companies with poetry, I think it's Dan Ives, because I read his research notes regularly, and he's got a way with words. Wow,
it's like you planned that transition, Ed. Bloomberg's Ed Ludlow, thank you for joining. Let's get back to that top story and the guy who does poems better than I do. Some of the world's largest technology companies are indeed complaining to U.S. antitrust regulators about Nvidia's acquisition of Arm. You have Google, Microsoft, and Qualcomm all saying that the deal will harm competition in an area of the industry that is vital to their businesses. Joining us to discuss, Dan Ives of Wedbush. Dan, I'm not going to make you rhyme poems, but I will ask you your thoughts on all of this antitrust news. Why now? What do you see as some of these big competitors now coming out against it?
Yeah, it's an arms race right now in terms of the chip world. And I think we're seeing a consolidation between software chips, and we even see companies like Apple with the M1. And I think this is really a shot across the bow. I mean, these companies don't want to see the deal go through. I think the street still thinks it likely does. But I think it just speaks to a convergence that we're seeing in what's really is the chips arms race on the horizon.
Dan, what is the increased likelihood that this deal doesn't go through?
I think right now the street still believes it goes through. I do think you're seeing this from a regulatory perspective, especially in this sensitive time in chips, because as we see the decoupling going on, which speaks of the chip shortage and coming off some of the U.S.-China cold tech war, I think it just speaks more and more important to how that could crimp the whole supply chain. And when you have one vendor with more and more control, there's a double-edged sword to that. And I think many view it as more downside than upside. And that's what really needs to play out in the market, especially in what I would call a little bit of a white knuckle period, especially on the heels of the chip shortage. That's an overhang on tech stocks.
I want to get to that chip shortage, Dan. First, though, you know more about multinational and cross-border deals. I was reading through Ian King's story, and he nails it. I mean, it's the FTC, it's the European Commission, it's the UK Competition and Markets Authority, it's China's State Administration for Market Regulation. How many regulators are we having to go through, and how much more does that complicate the story?
Yeah, it's a Rubik's Cube of regulators, and it does definitely complicate it, especially at a time with heightened focus from a regulatory perspective in this industry. And I think we're going to continue to see a bit of an Everest-like uphill battle as we go through more and more of the regulators, and that's why you saw the piling on today with those big tech giants, especially with Redmond and others speaking. I think that definitely is going to put more of a spotlight on this deal.
Why isn't the market pricing in that the deal might not happen?
Because right now, we've seen more and more barks and worse than the bite in these situations. And I think the market's learned over the last year or two that even though there could be noise, a lot of these deals ultimately will get through, even if there are potentially some concessions. So I think that's the view of the market right here. This would obviously be a massive deal. There's going to be a lot of noise. There could be some changes, but the market's still pricing the deal gets done.
And we should be fair, Dan. I do want to read Nvidia's statement on the FTC probe. And they say that we are confident that both regulators and customers will see the benefits of our plan to continue Arm's open licensing model and ensure that a transparent, collaborative relationship with Arm's licensees, and of course saying that that will continue. So of course we will bring you more comments from that company as we get them. Dan, as we transition from the arms race, as you mentioned, to this broader story of a massive shortage of chip supply, hasn't this just highlighted the issue that is?
No doubt, and this is coming off. We're going through a U.S.-China cold tech war, and that's why right now there's more and more focus on Biden administration. You've seen the halting of TikTok, and there's a view that there's going to be more and more of an olive branch toward Beijing because we're seeing some of the damage here, and it's the one thing that could crimp this global demand rebound on autos, on EVs, and really across the tech food chain if it does not get resolved, especially as it all comes down to Asia and in terms of what we're seeing from the shortages, and that's something that's being called out more and more across the supply chain, which is a bit nerve-wracking for investors as we continue to see a green light for tech, and we're coming off of the strong earnings. But this is something that could definitely ruin the party.
But is it a supply chain issue, or is this just massive, unprecedented demand, given the massive, unprecedented recession we just came off of?
Yeah, 75% of it is demand-driven. Demand has outstripped supply to a point that I think no one even anticipated that was within the goalpost. And that's something that becomes a high-class problem as we've seen demand spike, especially on autos, on EVs, and across the whole PC supply chain. But it also is supply shortages coming off of some of the bans that we've seen in China. And it does show the double-edged sword to doing that. And that's why there's more and more focus on 1600 Pennsylvania Avenue if we see a ratcheting down of the U.S.-China cold tech war, which we believe happens. And ultimately, I think that's just another bullish sign for tech stocks moving ahead.
Can 1600 Pennsylvania Avenue do anything in the short term?
In the short term, it's really theater, and it's more what I would say posturing at this point. They really can't do anything, and the supply chain is cemented in Asia. There could be some good words and some strategies, but really nothing's going to change the current situation. It all comes down to supply starting to get normalized, as well as the U.S.-China relationship.
Dan Ives of Wedbush, thank you as always for your time. And coming up, Bumble finally making its public debut and making its female CEO a 31-year-old billionaire just in time for Galentine's Day. We have a look into the company next. This is Bloomberg. A company catering to women and led by women has made its 31-year-old female founder a billionaire. Shares of the dating app Bumble soared in their debut, and now the CEO, Whitney Wolfe Herd's stake, valued at a cool $1.5 billion. She spoke to Bloomberg about what makes Bumble stand out among peers.
I'm just so proud of our team for getting to this day. It's been such a journey, and for those first people that believed in us and subscribed to this radical idea of a woman making the first move, they have been really what drove this home.
To discuss the debut of Bumble, we are joined by Rohit Kulkarni of MKM Partners. Rohit, the price action has been incredible. If you think of a stock that priced at 43, you were closing up near $80 a share. What do you see as the further upside bull case scenario for this stock?
Hey, thanks for having me, Taylor. And again, I think it's a fantastic time for any company that has a story that is getting stronger through the pandemic, as in more and more people are looking to find ways to connect to people through online dating apps. And a company like Bumble is offering exactly that. At current valuation, it is trading at a significant premium to its most commonly found peer like Match.com. But I still see that there are so many things that can go right for a company like Bumble. I see there are signs like Pinterest here, as in Pinterest came to the market with a story that they are woman-focused, which is a very powerful demographic. They are offering something that has a scarcity value, and a company like Bumble can continue to execute.
Is there any risk, though, just to jump in a post-COVID world, we're no longer swiping as much because we're out in the real world?
That is a risk. I feel companies like Bumble have their work cut out for them. They are trying to diversify into new things like professional relationships, platonic relationships, finding friendships and professional partners as well. So I think when companies like Bumble are looking beyond the pandemic, they are looking to monetize their connections through various different ways and not just online dating. But that's a risk. I think there is a lot of euphoria priced in right now. It's about execution. There is going to be volatility coming down the pipe.
Rohit, you nail it on your consumer surveys that you, the rest of the team, and MKM Partners does. And it caught my attention. One of the latest surveys you did was about another company that we follow quite often here on Bloomberg Technology, Peloton. The demand, does that make up for some of the delivery woes that we've seen?
Absolutely right. As in Peloton, we did a survey where we asked a lot of Peloton customers that, hey, when did you order a product, and are you frustrated with the delivery experience? And the median lead time is about 11 weeks. So that's almost 3 months before you actually get your order delivered. And majority of the people, 59% of the people, had experienced some issues with scheduling a delivery. So I think Peloton as a company is addressing that. Over the next 3 months, that is something investors are going to very, very closely monitor. Peloton is spending about $100 million to ensure that deliveries are being done on time. There is a fine line of customer service and customer satisfaction that the company needs to follow. So our surveys indicate the delivery times are getting shorter, hopefully not at a very big price.
How much more of a tailwind is that Echelon acquisition?
It is still very early days, to be honest, Taylor. They are still looking to close it. They are ramping up their production here in the U.S. As we get to the second half of this year, I think they will be better positioned. It is going to be expanding them into new markets and new kind of products, as well as getting into hotels and gyms, and that is somewhat of a counter-cyclical edge. At the other side of the pandemic, people going to hotels, people going to gyms will have their Peloton bikes ready and available. And I think that's a nice little customer acquisition channel for them.
Rohit Kulkarni of MKM Partners, always appreciate your time. Thank you. And coming up, billionaire Chamath Palihapitiya has plenty to say about GameStop and the phenomenon. Our conversation with him next. This is Bloomberg. Social Capital founder and CEO Chamath Palihapitiya is known for being a disruptive force in Silicon Valley. Recently, he's been making headlines as a superhero for the Robin Hood crowd on Reddit. In a Bloomberg Front Row interview, he shared his views on day traders versus hedge funds. Take a listen.
I think what GameStop showed was the narrative fallacy on Wall Street. I think for years, there was these folks that sort of, were these wizards behind the veil. And they had a way of conducting themselves that purported to be just intellectually superior to everybody else. But in reality, what that short showed was that they were prone to the same, poor decision-making and broken systems and technologies that everybody else has to deal with. And so I found that kind of funny. I think it also spoke to the fact that, we really haven't looked closely enough at the systems that were broken as a result of 1998 and LTCM, long-term capital management, then 2006, 7, and 8 with Bear and Lehman. And we're allowing the same problem, slightly different, but roughly the same problem, to repeat itself over and over again. And so that's what sort of angered me about GameStop. And then on the back end of it, I just felt like these two worlds collided in a way where I doubt that in the end, in the final analysis, there was any collusion of any kind. But just the stench of this whole thing just goes to show you, back to where we were talking about before, about how difficult it is for normal, everyday folks to have access to any kind of return. So if we break down the capitalist philosophy, they are just fundamentally stuck in this cul-de-sac of always being labor and always being sort of at the, ownership of capital, of the ownership class. And the fact that normal folks can't get access to returns and, close the inequality gap is just going to make all of the things we're dealing with today a lot worse than they already are.
From what I can tell, you appear to have reconsidered a couple of the things that you said in the heat of the GameStop moment. Where do you stand on hedge funds as a group of actors and the role they play in modern finance? And also the other thing that came up in the context of the situation, short selling.
I think hedge funds are a really important part of the financial infrastructure, and I think that they should exist, and I hope that, the ones that are good can thrive. But I also believe that disclosure needs to get improved. I think in every other part of society, as the internet has become more sophisticated, as software has become more sophisticated, things have erred towards real-time disclosure of everything in every market. It's just not true in finance, where people are able to sort of use the rules and bend them to obfuscate the truth. So, for example, there was a rule that the SEC was considering where you wouldn't have to publish your longs anymore on the same frequency. To me, that's nuts. I think that actually, we live in a world where your longs and your shorts should be published in real time. Because again, what separates you should be your analysis and your interpretation of the facts, not obfuscation. Another thing is that I think that you should be, forced to disclose the margin that you're running and how much leverage you have. And, I think that hedge funds and banks are no different. They're a critical part of the financial infrastructure. They should be treated in the same way. And instead, I think after 2007 and 8, a lot of the risk effectively, quote unquote, went off balance sheet and away from the banks and towards these other really important actors, but who just don't have that much oversight. I still think hedge funds will do really well. I still think that there are some folks who are incredibly talented who will make just a ton of money for themselves and for their investors. But I think disclosure needs to go up. In terms of short selling, I buy the fact that it's an important part of the market. I'm not a huge fan of it. I do think that certain folks really use it to run a neutral strategy. And, I think that that's great. But I also think that, now in the world of social media, and we've seen this recently, disinformation can be used to not just cause political damage, but I think disinformation can also cause economic damage. And so I think that the SEC is going to have to deal with that issue and figure that out. How do we manage information or interpretation or sensationalizing of things that all of a sudden can whipsaw the markets up and down? And these actors, how are they regulated? Are they allowed to just say whatever they want and the implications are what they are? Or is there a higher standard now that there's so much distribution for so many more people?
That was Social Capital founder Chamath Palihapitiya in our exclusive Bloomberg Front Row interview. You can watch more of that conversation on Bloomberg Front Row all this weekend, starting tonight, 8 p.m. Eastern. And coming up, the cloud monitoring business has soared over the last 12 months. So why is a company like Datadog taking a hit? We're going to speak to the CEO next. Conservative guidance, but analysts loving the stock. Plus, later, we will hear more from Chamath Palihapitiya on the newest craze to the public markets, the SPAC attack. The SPAC attack. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in New York, filling in for Emily Chang. Datadog, the cloud monitoring platform with clients such as Airbnb and Peloton, reported earnings that left investors a little weary. The company beat estimates but provided a cautious outlook, which caused shares to drop in intraday trading. With more, let's bring in Datadog co-founder and CEO Olivier Pommel. Great to have you. And analysts just reading through the notes today, highlighting just the sky-high valuation and perhaps maybe wanted more out of the outlook. What do you say to them?
Well, I'll say we're very happy with our quarter. We're super happy with the year, and even more optimistic about what's coming next. I would say I don't pay too much attention to the stock going up and down a few percent every other day. I think that's par for the course when you have really high growth. But overall, I will say our stock is up a lot in the past year and even since the beginning of the year. And I think judging by the pace of change in digital transformation and cloud migration, I think we're very optimistic about what's coming next.
Talk to me about what's coming next, because Rosenblatt Securities was talking about your emphasis on R&D and maybe squeezing profits in the near term, but really opening up a broader opportunity for growth down the line. How are you thinking about that mix between R&D spend versus profitability?
Yeah, so we actually had a very good year in 2020 for profitability. We grew 66% through the year with 14% in free cash flow, which I think it's hard to ask for more than that. The business is not any different. I think we could be profitable quite a bit if we so wished. But we're at the very beginning of what's a very large opportunity. The whole world, like companies big and small, are moving from legacy IT to public and private cloud, and we're investing to capture as much of that market as possible. So the truth of it is, this year we're planning to hire as much as we can without breaking the company, basically, so that we can capture that market.
Is that more of an international market?
It's everywhere. It's everywhere. It's in the US. And what's really interesting is one thing we've seen this year with the pandemic is that, of course, there were a lot of success stories that you would expect, such as, for example, our customers in streaming or in video games or in e-commerce that did really well and grew a lot and grew a lot with us. But perhaps more surprisingly, we also saw customers in industries that were really impacted by COVID that also embarked in the transformation and cloud migration. I'm thinking of airlines, amusement parks, hotel chains, and the companies that are really in a tough spot right now, but that understand they need to modernize, basically. What this means is, there's a very large opportunity ahead of us, and we want to go after it.
Yeah, have some of those companies indicated to you that tech spend is going to come back really strong when it can?
Well, as far as we're concerned, we're where the spending is going, right? We're in the next generation, we're in the cloud, where the investment is being made, and the part of the stack that is growing very fast. So there was never a concern for us that this was going to compress and go away.
I think what's fascinating about the growth of your company, and analysts are highlighting that, of companies with annual recurring revenue of more than $1 million has grown to 97 in your company from just 50 a year ago. What is the focus? What can we expect from you on a focus of companies with 100,000 of recurring annual revenue going up now to at least $1 million?
Yeah, what's really interesting is in this new world, the cloud world, the developers that work in small companies and small startups actually use a lot of the same tools as the developers that work in the very largest Fortune 500 organizations. And we actually serve that whole spectrum. We serve customers that are at the very low end of that, even customers that don't pay us any money, students, individuals. And we also serve the largest organizations that pay us millions or even more every year. And so as far as we're concerned, we're growing everything. We're serving the developers, and I would say they're equally distributed in all of those categories.
You also recently announced an agreement to acquire, I believe it's Screen, a security platform. We've all really been focused on security. How does this help you push forward to the future, given how much security has become an increased focus?
Yes, definitely. Security is on everybody's minds right now. What's really interesting about Screen is that what the company focuses on is application security. And when you think about it, we're all using more and more applications. More and more of our data is being manipulated by those applications. And so these applications are getting more and more complex, and more of them are being developed. But at the same time, it's really, really hard to secure them as they're getting more complex. I mean, the developers that build them, they have a hard time of understanding how the applications even work. So it's even harder to secure them. What's really interesting there is that what we do for a living already at Datadog is we help our customers, developers, understand what their applications are doing, how they're working, and basically tame the complexity for them. So this is really a logical next step for us. That we understand the application, we make it easier for them to understand them, then we help them protect the applications and secure them.
Would we expect more acquisitions like this in the future?
Potentially. I mean, we've announced 2 yesterday. We've done a few last year. We have a very large market ahead of us and a very large problem space we can solve for our customers. And so some of that we'll solve ourselves by hiring engineering teams and building product and spending the years it takes to learn a market. And in some other cases, when we can, we will accelerate and acquire and leapfrog basically that whole category.
Well, we're hoping that when you do make those announcements, you will come back and join us and talk to us more about that. Olivia Palmer of Datadog, who is the co-founder and CEO. Thank you so much for your time. And more on the SPAC boom. Social Capital founder and CEO Chamath Palihapitiya is considered by some to be the, quote, king of SPACs. 6 blank check companies and billions of dollars he has raised so far. Bloomberg's Eric Schatzker spoke exclusively with him about the future and, well, limitations of the blank check boom. Take a listen.
I think what's happening in SPACs is really about the dismantling of the traditional capital markets with respect to fundraising. So the equity capital markets, really had one go-to move, which was the IPO. And then obviously there was follow-on financings and all of that other stuff, but the traditional S1 driven IPO process. And what you picked was a brand that you trusted to be your on-ramp into the public markets. I think in 2021 and going forward, you're still picking brands, but that choice has become more atomized. But that is the exact same decision that used to happen 25 years ago when you used to pick a banker. Except now you're picking an individual level partner. And so I think that SPACs are very much here to stay. Back in the, using the language of inequality, it evens the playing field. It democratizes access to high growth companies. How? Because it allows retail and it allows long tail institutional investors, folks that may not have necessarily been tier one hedge funds. Now they can also play. They may get allocation in the original SPAC IPO. They can go buy in the market as soon as it goes public. They can participate in the pipe. They can buy after a deal is announced. So many opportunities versus one allocation in a book building process that a traditional S1 process was all about.
You describe finance often as a game rigged in favor of insiders at the expense of outsiders, especially the retail investor, the little guy, if you will.
Yeah. I think this is a really good point you're making. If you can generate superior returns, you should be allowed to compensate and participate yourself in that. When I used to manage institutional money, again, all of this capital is my own, but when I used to manage institutional capital in early stage investing, I charged a 30% carry. No hurdle, no nothing. And people were willing to bet that I could generate returns, and I have, 30+% returns over the last decade, that justified a 30% carry. Similarly here on the deals that I do, I take a 20% carry. And I think that I can find targets and find opportunities that will make that more than reasonable in the final analysis. And I think that if you look at the returns we've generated for shareholders, it's been nothing short of incredible, inclusive of the carry that I've taken. That being said, I've always thought it was important as well to do two things. Number one, Eric, is to put a lot of my own money on the line so that there was never a question of why I was in this. And I was in this to make sure that I could find great companies that I thought, again, fixed inequality or climate change. But then second, to accelerate those things with our capital and to make sure that I could explain it to people, including normal folks and retail investors. And I do that by saying, listen, just so you know where I'm coming from, I'm going to put in more money than any of you, and you should take that as a serious signal that I think that this is important, and I take it very seriously. The reason why we cannot give access to the pipes and some of these other mechanisms to retail is because of very strict regulatory definitions that we live by about who is a quib, who is an accredited investor, and those things are changing, but they're changing slowly. My perspective is that right now, the way we define it is too broken. So I think that there's work that I can do, and hopefully people will listen to those arguments and expand the rules. And that way, more people will be allowed to buy pipes and these other things. But I want to be really clear. That is where we would like to move the ball so that everybody can be in an open, even playing field, bid for the IPOs, bid for the pipes, participate with complete transparent information.
Social Capital founder Chamath Palihapitiya in our exclusive Bloomberg Front Row interview. You can watch more of that conversation on Bloomberg Front Row all weekend. There's nothing else to do. Stay home and watch us. It all is happening 8 p.m. Eastern Time. And we bring you more news in the world of the SPAC attacks. It continues, this time coming from Coastlet Ventures, of course, the VC that finds itself dating back to 2004, number 3 now filing for an IPO. And we're also getting news that acquisition number 2, that SPAC looking to raise about $400 million. So just the SPAC attack craze, it continues. And coming up, a conversation with Allraise CEO Pam Costa as her group seeking to diversify boards of high-growth tech companies. An important conversation, and we do that next. This is Bloomberg. Calls for racial and gender equality have reached boardrooms from Wall Street to Silicon Valley for some time. And one organization, All Raise, is teaming up with some of the leading firms in VC to build a network and filled board seats with the best talent, targeting women and underrepresented men. Joining us to discuss this effort, Pam Costa, the All Raise CEO. Pam, great to have you. Talk to us about how much easier this initiative has become, given the heightened focus on this issue really just in the last year.
Yeah, there's been a great drumbeat of interest and movement across the industry for diversifying the boardroom. And it really started, I guess, with Goldman Sachs CEO pushing for changes in terms of the types of companies that they would take public because they saw the economic benefit of diverse boards in terms of IPO performance. It was followed up with California legislation, recent moves by NASDAQ and promotion, and just the general heightened interest and awareness of the economic benefits of having diverse boards, which tend to outperform their non-diverse counterparts.
Talk to me about the companies coming to you asking, what are they demanding in terms of talent?
Yeah, the demand for talent has just skyrocketed. Obviously, savvy CEOs know that having a diverse boardroom and great independent board members can help accelerate the success of their organizations. And so they're really looking for experienced professionals who can help them see around curves. And they're looking for diversity in terms of gender, in terms of race, in terms of bringing new perspectives and different perspectives that help them understand the market opportunities, where the markets are going and being shaped moving forward. And so we're seeing a broad request for many different types of individuals and capabilities across go-to-market, finance and audit, and general operating capability.
The process, though, starts long before. It's about cultivating the talent years before they're ready to be the CEO and on the board. What are you doing to fix that long process where you really have to start at the beginning and cultivate that talent so that there really is a broad pool of which we can choose?
Well, there is already a broad pool. There's often the mistaken myth that there's a pipeline problem. There is a broad pool of individuals who are board ready and board capable. The process itself of how boards are constructed today is really where the issue lies. Most of the time it is through networking. Board decides that it's going to expand itself and it begins to kick off a process of who do we know? And the fact is that they just don't know the talent that they want to access. And so there's not an existence of we have to build and groom, but we should continue to do that. But there's a plethora of board ready talent for women, for Black individuals, for Latin individuals that are ready to serve on boards and capable of delivering value today. So we shouldn't fool ourselves into thinking that there's a pipeline problem so much as a network access problem.
Yeah, I love that. And thank you for the clarification there. Pam, I think you brought up a really good point about the pure financial performance of boards that are diverse do better. What do some of the statistics tell you about those companies that really are rich and full of diverse talent?
Yeah, well, we know diversity across the board helps. The boards, if you look at the performance of boards, they tend to be more innovative, more creative. They have more efficiency. They have less risk. And we know that actually that trickles down into the teams themselves. So we know that diverse teams of companies also tend to outperform their counterparts on the Creativity and Innovation Index, but also they tend to exit faster, 1 year faster than their all kind of male counterparts. And so we really want to be making sure that we're focusing on the economic benefits of diversity. There's plenty of evidence that it exists, actually, we call it the tsunami of evidence that exists for board diversity and diversity in organizations themselves.
There was some concern that there was a lot of talk and not a lot of follow through. Which sectors are doing the best job of committing to their words?
Yeah, I don't know that it's sector specific. We actually have placed individuals at 5 different companies. They range from enterprise organizations to consumer organizations. It's really about the leadership and the commitment of the leadership to recognizing the benefits of diversity in terms of creativity, innovation, and performance. And so it's really about who is leaning in and recognizing and wants to take advantage of this first mover benefit from getting more diverse boards.
if we want to, let's say, mirror society, right, 50-50 men, women, just as an example to pull from, what is a realistic timeline that you see in which we can get there?
Yeah, there's, the statistics for representation on private boards is pretty dismal. 60% of private boards don't have a single female, and the representation of women on boards in general is hovering, and private boards in general is hovering around 7%. So we have a lot of work to do here. Representation for underrepresented individuals is even less. So we have a significant amount of work and progress to do. We believe through programs like Board Accelerate, which we just launched here at AllRaise, that really focuses on a 90-day window in which to find, identify, and place a candidate on a board, that we can actually make hundreds of placements in any given year. So the pace at which we're going to be moving forward as an industry is accelerating.
Pam Costa, the AllRaise CEO, thank you so much for your time and shedding a light on this really important matter. We appreciate it. And coming up, Expedia still in an uphill battle with the pandemic as revenue, well, it continues to decline. We will hear from the CEO next. We're going to migrate on out to San Francisco. Take a look. Do we have a live shot? Oh, I should sing the song, the Tony Bennett song. I left my heart in San Francisco. This is Bloomberg. Expedia seeing lingering COVID effects. The stock struggling after reporting another steep drop in revenue in the fourth quarter, missing analyst estimates, all amid a surge in COVID-19 cases and new pandemic-related restrictions, all of which have been weighing on travel in the last few months of 2020. Expedia Group CEO Peter Kern discusses business amid the pandemic and his expectations on the travel industry as more people get vaccinated. Kern spoke in an interview with Bloomberg's Kaylee Lyons and Guy Johnson.
We mentioned in our earnings that we're starting to see some better numbers in January. And I think that's a reflection of essentially consumer confidence, people's belief that they will be able to be vaccinated. They can plan ahead and get to their summer vacation or their fall vacation. We're even seeing, the holidays of next year of this coming year at Christmas time be a little up over historic periods. So I think people are starting to plan out a ways, but it's vaccine. It's also consumer confidence in the vaccine coming. So I don't think it's necessarily shots in arms as much as people's belief that they will get their shots in their arms. And so I think we're starting to see that unfold now. It's not that so many people have been vaccinated, I think, to drive the numbers for us. I think it's really more an expectation that it will be possible in the coming months, and therefore they will be able to go places come this spring, summer, fall. And that's what we're starting to see.
How broad is that trend, though, Peter? Is that mostly focused on domestic travel? Are you seeing it yet for long haul?
No, it's a good question. It's definitely domestic. I think people are still not sure what it's going to take to go international and what they'll have to do and what will be allowed. And and again, there's a fear of, okay, I love going, let's say an American who loves going to Europe in the summer. What will I be able to do there? Will I have to wear a mask? Will restaurants be open, et cetera? So I think there's still a lot of unknowns. And that's why I say I think it's got more to do with people's confidence in what they'll experience than it does with whether they can go. And so I think, yes, it's still highly, highly domestic. Now the industry can rebound considerably from where it is while still being mostly domestic. So I don't think it's that we're stuck here until international comes back. It's just a question of when does international come back and everything is really fully open, and that, we're all looking forward to that time.
What are you seeing in Europe, Peter, more specifically? Clearly, it looks like it's going to be difficult for Americans to fly over here, but within Europe, what is the picture?
Yeah, well, as you just remarked in your stats on lockdowns, Europe recently has been much more locked down. The U.S., for a variety of reasons, has been less controlled. And so what we're seeing in Europe is these lockdowns, which tend to be quite severe and quite serious, they really limit, obviously, travel. But as they open, we're seeing many of the same trends we see in other places in the world. People are doing more alternative accommodation rentals, in our Vrbo brands and other alternative accommodation opportunities. They're doing it more locally, drive to rather than fly. And so it's basically the same phenomenon. The borders are a little closer together, but it's the same phenomenon. When they can cross borders, they certainly do. But again, it's a lot of driving. It's a lot of, what we would call near travel as opposed to perhaps domestic, but not as many people flying clearly, and a lot more rules around that. So we're seeing pretty much the same trends, just the countries are smaller and the borders are closer.
Expedia CEO Peter Kern. That does it for this edition of Bloomberg Technology. Bloomberg's Wall Street Week is up next. Happy Galentine's Day to my single ladies. This is Bloomberg.